Okay, what I wanted to show on here, this is actually a VUL. So it's a variable universal life. And I actually had one at the time. It was sold to me more like a rich man's Roth, right? Where you don't qualify to put in a Roth IRA. We can put money in here, get the returns of the market, and it's tax free. Most VULs are more where they're actually tied to the market or to a specific fund, index, or and the IULs are tied more to an index, but now VULs are now getting into the index game here. And this was a client, and we're going to come back to this a couple times, but what I wanted to show here is that there's 3 different scenarios on the illustration. I know if you're listening, don't worry, we're going to just walk through them, but really there's 3 scenarios. One is more of with no rate of return, with a guaranteed expenses, which, that's something we haven't talked about.
Yeah.
But which we will here in a minute. But scenario 2 with a rate of return with the guaranteed expenses. And then scenario 3 is with the rate of return with the non-guaranteed expenses. And really, as we alluded to earlier, there are expenses in this policy, and the contract does have a cap on what those expenses can be. So these first 2 scenarios are if you had the max expenses a company can allow you to charge. And then the third one is more of this is really what we're currently doing. What I find, I don't want to even say interesting, I might find scary, is of these 3 scenarios, the first scenario has 0, aka a bankrupt or lapse at year 18. And with the rate of return, with the max expenses, this goes bankrupt in 26 years. Now, the illustration we just looked at reflected an average rate of return every single year of about 6.2%. Now, it's very possible the market or the policy could do better, right? But my view is maybe it could be better, or maybe it could be bankrupt.
Mm-hmm.
And particularly if you're using this for retirement planning or using for cash flow in retirement, then the risk of something like that happen is going to be even more, is going to be higher. So to me, maybe you get a little more, or maybe you don't. And it's just the juice is not worth the squeeze.
Oh, guys, if you had one of these policies, I've recommended this before. If you're looking at kind of the range that is projected on your illustration for a UL, reach out to your agent and ask them where this policy is going to end up, and ask them to explain kind of the 3 options. Inevitably, every single time I've had somebody do that, they always come back with this answer, and they say, well, that's not likely to happen. That's literally the only thing that they have ever said. And guys, I got to tell you, I've been in this industry too long. I've had too many poor experiences where these illustrations do not work out the way that they're projected. So be very cautious.
And you know what'll make it worse? Particularly you start drawing some money out in retirement. If this thing goes bankrupt, you lose the tax protection of the policy. And if there's any gain in the policy from the amount that you had taken out before, you're going to get a 1099.
Yeah.
And you don't obviously you don't have the money to pay the taxes, or maybe you would have kept the policy, but then also we lose the death benefit. So
guys, if you haven't been able to tell yet, we're almost 40 minutes into this, and we're still going strong. We are still beating up on this thing. Yeah, right. So stick with us. We're going to wrap up here pretty soon, but we do need to make some very important points, because again, people are being misled out there, and we want to make sure that you guys are educated and understand when somebody approaches you.
You want to see the entire episode? Click here. If you want to learn how investors use infinite banking to increase their returns and lower their taxes, click here. If you want to see if infinite banking is for you and you have some questions, hop on a discovery call with us and one of our coaches. The link for that will be in the description.